$3.45. This is the yield on a lifetime of work. You sit at a wooden desk, the soft glow of the desk lamp casting an orange hue on your face, the digital statement on your phone screen casting a faint blue glow in the dimly lit room. The clock on the wall reads 10:14 p.m., a lonely hour when the world outside seems to have slowed to a crawl. Yet, in this stillness, the financial system hums quietly, its mechanisms whirring like a well-oiled machine, extracting utility from your labor, one transaction at a time. The balance shows $34,500, a sum that took 40 months of overtime shifts to accumulate, the exhaustion etched on your face a testament to the physical and emotional toll of earning that money. Yet, the interest earned does not cover the cost of a single cup of coffee, a bitter irony that would be comical if it weren't so cruel. The financial system is not designed to help you build wealth, but to extract utility from your labor. It operates through distinct tiers, each applying a different set of hidden mechanisms, like a master puppeteer controlling the strings of a marionette. By understanding these levels, you see how the bottom 90% is systematically separated from their capital, forced to dance to the tune of the system, never quite understanding the underlying rhythm. The machine operates under a set of rules that are never explained in classrooms, its inner workings a mystery that only the initiated can decipher. You find yourself trapped in a cycle of earning, saving, and depreciating, a Sisyphean task that seems to have no end. Every transaction you make is monitored, measured, and monetized by institutions that do not share your interests, their sole aim to maximize profit at your expense. The advice you received in your youth to study hard, get a stable job, and save your money is structurally flawed, a relic of a financial era that ceased to exist decades ago, when the rules of the game were different, and the game itself was less rigged. Level 1 is the cash penalty. This is where you are penalized for holding the currency you work to earn, a seemingly innocent activity that is actually a trap, a hidden mechanism designed to extract value from your labor. You believe that saving money is the path to security, but inflation acts as a silent wealth tax on your bank account, a stealthy thief that steals from you under the cover of darkness, leaving you with less than you started with. In June 2022, the inflation rate in the United States reached 9.1%, meaning your $34,500 lost $3,139.50 in purchasing power over 12 months, a staggering amount that would have bought you a decent used car just a few years ago. The bank did not notify you of this loss, no warning signs or alerts to prepare you for the impending decline. They simply adjusted the prices of groceries, fuel, and housing, leaving you with less, a gradual erosion of your purchasing power that seems almost imperceptible, like the slow dripping of water from a leaky faucet. Your deposit was lent out by Wells Fargo to corporate borrowers at 6.5%, generating revenue for the institution while your capital decayed, a seemingly innocuous transaction that is actually a masterstroke of financial engineering. The system forces you to take market risk just to maintain your purchasing power, a Faustian bargain that seems to have no end, a never-ending cycle of earning, saving, and depreciating that leaves you trapped and bewildered. You are told that cash is a safe haven, but the currency has lost 96% of its value since the creation of the Federal Reserve in 1913. Every hour your money sits idle, it represents a transfer of value to the financial entities that issue it. To stay afloat, you must constantly purchase assets that appreciate faster than the currency depreciates. If you fail to do so, your hard work is slowly dissolved by the expansion of the money supply. This process accelerated in August 1971, when President Richard Nixon suspended the gold window, turning the dollar into a pure fiat currency. Since that date, the money supply has expanded exponentially, reducing the purchasing power of every dollar you earn. Holding cash is equivalent to holding a government bond that yields nothing but guarantees a loss of 2.0% to 10.0% annually. You are running on a treadmill where the speed is controlled by the central bank. Your local bank branch does not explain how the monetary base expands through asset purchase programs. They simply provide a glossy brochure showing a 0.05% promotional rate that requires a $10,000 minimum balance to avoid monthly service fees. This is what inflation actually feels like. The first rule: cash is a depreciating contract that transfers purchasing power from the saver to the debtor. Level 2 is the credit trap. You are told that a high credit score is the ultimate indicator of your financial health. The FICO score, introduced by Fair Isaac Corporation in 1989, does not measure your wealth or stability. It measures your consistency as a debt servicing unit. If you pay off your loans immediately and carry zero debt, your score can drop. The system knows one thing about you. This is the credit plateau. You maintain a score of 780 by keeping credit card utilization at 9% and paying $120 in monthly interest fees to Chase Bank. The scoring model rewards you for remaining in a controlled state of indebtedness. You are encouraged to borrow for depreciating assets like cars, where the average interest rate on a new vehicle loan reached 7.18% in Q1 2024. If you pay off your credit card balance in full every month, the bank labels you a deadbeat because you generate no interest revenue. The algorithm penalizes you for self-sufficiency. It rewards you for maintaining a perpetual flow of payments that feed the balance sheets of the financial sector. The scoring models are designed to measure how consistently you transfer a portion of your wages to financial intermediaries. A borrower who maintains a balanced portfolio of revolving debt is considered prime, while a cash-only saver is flagged as high risk. Credit bureaus like Experian and Equifax track your habits to sell your profile to lenders who design interest products specifically for your wealth tier. The entire credit scoring infrastructure is a marketing tool disguised as a financial safety rating. The total auto loan debt in the United States surpassed $1.6 trillion in 2024, with average loan terms stretching to 68 months to extract maximum interest from your daily labor. The second rule: credit scores measure your profitability to lenders, not your financial independence. Level 3 is the savings spread. You deposit your paycheck into a savings account at JP Chase, which pays an interest rate of 0.01%. Under the Federal Reserve's Regulation D, banks use your deposits as reserve capital to leverage their lending activities. Since March 26, 2020, the reserve requirement ratio has been set to 0%. There is no relationship here. There is a transaction. The bank takes your $34,500 and uses it to underwrite auto loans at 7.2% and credit card debt at 21.5%. They capture the massive interest rate spread while paying you pennies. The spread is the business model. The bank leveraged your risk-free deposits to create loans that yield returns hundreds of times higher than the interest they pay you. If you attempt to withdraw more than $10,000 in cash, you are met with compliance forms under the Bank Secrecy Act of 1970. You must justify the use of your own money to bank employees who treat you with suspicion. Your liquid savings are not yours to control. They are a cheap source of raw material for the bank's leverage machine. The physical reality of your savings is a digital entry on a ledger maintained by servers in a data center. If a systemic crisis triggers a run on the bank, the institution has the legal authority to suspend withdrawals or limit access under emergency liquidity protocols. The repeal of the Glass-Steagall Act in 1999 allowed commercial banks to merge with investment banks, exposing your savings to market speculation. If the bank fails, your deposits are insured by the FDIC up to $250,000, but the agency holds reserves that cover less than 2% of total deposits. You pay monthly maintenance fees of $15 unless you maintain a minimum balance, while the bank charges those who drop below zero a fee of $35 per transaction. The third rule: your savings are the raw material that banks use to manufacture expensive debt. Level 4 is the Cantillon tax. When the central bank expands the money supply, you experience the price increases long before you see any wage growth. This phenomenon was first described by Richard Cantillon in 1755. The Federal Reserve increased its balance sheet from $4.1 trillion in March 2020 to $8.9 trillion by March 2022. Something changes. Not dramatically. By the time the new money reaches your salary, prices have already risen. The S&P 500 index rose by 108.1% during that period, enriching asset owners while your real purchasing power fell by 2.3%. Those closest to the money printer, such as primary dealers and investment banks, receive the new currency first. They deploy this cheap capital to buy real estate and stocks before the inflation hits the broader economy. By the time the cash trickles down to your local grocery store, the dollar has lost its purchasing power. You pay 30% more for bread and meat while your hourly rate remains unchanged. The flow of newly printed currency resembles a wave that dilutes value as it spreads through the economy. By the time it reaches the wages of the bottom 90%, the pricing of scarce assets has adjusted upward to reflect the new monetary volume. In 1980, the average home price in the United States was 3.5 times the median household income, but by 2024, that ratio climbed to over 6.0 times. You are forced to save more dollars for assets that are moving out of reach due to monetary debasement. Wages are sticky, meaning they adjust slowly, while asset prices respond instantly to new liquidity. The wealth gap is not caused by lack of effort, but by the physical sequence of money distribution. The fourth rule: inflation is a regressive wealth transfer that rewards asset owners at the expense of wage earners. Level 5 is the labor premium. You are encouraged to seek a higher salary as the primary way to escape financial struggle. You work 50 hours a week to earn a raise, moving from a 12% tax bracket to a 22% tax bracket. The tax code is structured to favor investment income over labor income. Your W-2 wage is taxed immediately at the source, including a 15.3% payroll tax for Social Security and Medicare. A capital gains investor pays a maximum rate of 20% on long-term profits. This is what labor actually feels like. You pay a higher percentage of your income in taxes than a real estate corporation making millions. They use depreciation write-offs under Section 179 to reduce their liability to zero. The tax system enforces a penalty on productivity. It ensures that the person who sells their time pays more than the person who sells their assets. To build wealth, you must transition from earning a wage to owning capital, but the high tax rate on your salary prevents you from saving enough to make the transition. The tax code includes thousands of pages of deductions, exemptions, and write-offs that are inaccessible to a standard salary earner. These provisions are designed to encourage corporate investment, leaving you to carry the tax burden of funding public infrastructure. The Tax Cuts and Jobs Act of 2017 lowered the corporate tax rate from 35.0% to 21.0%, while individual income tax rates remained comparatively high. The system prioritizes the growth of the corporation over the survival of the individual. Self-employed individuals face double taxation because they must pay both the employer and employee portions of FICA taxes, totaling 15.3% before state and federal income taxes are applied. The fifth rule: the tax code is written to subsidize capital and penalize human labor. Level 6 is the liquidation wall. When you need cash to buy a car or pay a medical bill, you are forced to sell your investments. This liquidation triggers capital gains taxes and interrupts compounding. The wealthy do not sell their assets to access liquidity. The rules become flexible. An investor with a $10.0 million stock portfolio takes a securities-backed line of credit at 4.5% interest tied to the secured overnight financing rate. This loan is non-taxable, allowing them to spend millions without triggering a tax event, while their assets continue to grow at 8%. They buy real estate, fund lifestyles, and reinvest the borrowed capital without paying a single dollar in income tax. When they die, the assets receive a stepped-up basis, erasing all capital gains liabilities for their heirs. You are trapped on the other side of this wall. You must sell your stocks, pay 15.0% to 20.0% in capital gains tax, and restart your compounding cycle from scratch. This dynamic creates a permanent wealth divide where your assets are constantly pruned by the state, while the portfolios of the wealthy remain intact. The compounding process is never broken for those who use debt as their primary source of liquidity. Under Internal Revenue Code Section 1014, the stepped-up basis adjustment resets the tax cost basis of inherited property to its fair market value at the date of death. This allows generational wealth to escape capital gains taxation entirely, while your retirement savings are taxed as ordinary income upon withdrawal. You must liquidate your assets at the worst possible times to cover emergencies, while the wealthy borrow against their portfolios to buy more assets during market downturns. The sixth rule: liquidity for the wealthy is a tax-free loan, while liquidity for the bottom 90% is a taxable event. Level 7 is the risk subsidization. You are taught that the market is a meritocracy where those who take risks bear the consequences. If you make a bad investment or default on your mortgage, you face foreclosure and bankruptcy. For the largest financial institutions, the rules of risk are entirely different. During the 2008 financial crisis, the Emergency Economic Stabilization Act provided $700.0 billion in taxpayer funds to bail out insolvent banks. In March 2023, the Federal Reserve created the Bank Term Funding Program to support banks facing bond losses. The Federal Reserve operates a systemic backstop, often called the Fed put, which intervenes to support asset prices whenever markets decline. The profits of financial engineering are privatized, while the systemic risks are socialized. You carry the downside of your choices, but institutional actors have their downside protected by monetary policy. When the central bank lowers rates to save the market, it devalues the currency in your pocket to protect their balance sheets. This structural asymmetry ensures that the top tier can take massive risks for profit, knowing you will underwrite their losses through inflation and public debt. The system ensures that the largest market participants are shielded from the consequences of their leverage. The cost of this protection is paid by you, through the erosion of your purchasing power and the accumulation of national debt. The concept of too big to fail, established during the 1984 rescue of Continental Illinois National Bank, creates a moral hazard where large financial institutions are guaranteed survival at your expense. They operate with a government backstop that is never extended to your personal mortgage or student loans. When the Federal Reserve purchased devalued Treasury bonds at par value from banks in 2023, it protected institutional balance sheets while leaving you to deal with the resulting price inflation. The seventh rule: the financial system insulates the top tier from losses while leaving the bottom tier to absorb the shocks. The shift